be here too, Dave. Thank you very much.
That's very nice. You know what? Let's start off with what is happening in the mainstream media. I mean, all I hear and every place I look, I see housing crisis. I see recession in 2020, inverted yield curve. Everything's pointing to something ominous that's about to happen here. With all your research and everything that you've been looking at, I mean, are we headed into a recession?
We have already begun. We never really, Main Street never pulled out of the crisis that happened in 2008. But, when you talk about mainstream media and you talk about the inverted yield curve, these guys talk out of both sides of their mouth because they keep saying, and if the yield curve inverts, and then the next sentence they show you how indeed the yield curve has inverted. And in fact, it inverted in China. Their yield curve inverted in May of 2017. And in the EU, they are very near, if they haven't already gone into an inverted yield curve. So this is happening on a global basis, not just in one country or another. And we're all together in this mess. I'm very nervous, to be perfectly honest with you. I'm very nervous about what I'm seeing.
You mentioned the yield curve. And the Fed, a little while ago, came out and said, the yield curve is really not that important. When it inverts, it doesn't really mean that we're going to be heading into a recession. So, I mean, are they right? Or are they trying to, direct everyone to look over here instead of over here?
You got it. Because other reports that they have conducted and studies that they have conducted show that every time a yield curve inverts, you end up with a recession. Because what that is, just for people that aren't familiar and they're kind of hearing about the yield curve inversion, the short-term rates are higher than the longer-term rates on debt. And when you stop and think about it, interest rates are supposed to be an indication of the value of money. So if you have money right now, those rates should be the shortest. If you loan it out, you get it back quickly. The longer that you're willing to hold that debt or fund that debt, the more you're supposed to get paid for it. So when you have short-term rates higher than your intermediate and long-term rates, what does that tell you about the value of the money that you get back down the road? It's not worth even marginally as much. So it's a very big deal. And according to their own research, it always foretells a recession, but they don't want you to get prepared for that.
Now, what's very confusing to many people, Trump is out there saying, oh, look at GDP, look at the unemployment rate, very low. He's saying that the economy is doing very well. And then you have, on the other hand, the mainstream media saying that we're heading into a housing crisis, we're heading into a recession. So we have both sides here on opposite ends telling us two different things about the economy.
Well, that's why I like data. Because anybody can blah, 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 say anything that they want. That's why in my work, I always show you why I'm saying what I'm saying. And so when I'm looking at the data, the housing actually, the housing crisis started to unravel in 2016. It has now escalated, but the price movement peaked in March of 2018. So there were already cracks in 2016. And I think maybe 6 or 8 months ago, I did a video showing how the low end was being squeezed, but also the upper end was also being squeezed. You have China that was up until the crackdown, the beginning of this year or the end of last year, whenever that started. You had them as huge buyers of U.S. real estate. And the government cracked down on that because the funds were trying to flee China. And they cracked down on it, Ambang and all those guys. And so they've been selling off all of that real estate that they paid top dollar for. So no, residential, they are counting on the first time. I mean, I have all the proof of this. They're counting on the first time home buyers to support the real estate market, which is 20% of the GDP when you take into account all the peripheral issues that real estate funds. So 20% of GDP, and it peaked out. It started the decline in 2016, and the pricing started to peak out in March of this year. And you've got a lot more selling pressure coming into this market with real estate and a lot more negative data. No, we're in a bear market. Though I will say, if you look at the real estate ETF, so Wall Street derivative product, that the reality of that price does not reflect the reality of what's happening underneath. You know, you've got all of these store closures that are happening, you know, brick and mortar. I mean, come on, please. Who is stupid? You can look in your neighborhood, you can see.
So is this, I mean, when we talk about this recession, is this just a correction, a small recession, or is this the transition? Is this the big one?
This is the big one. And I'm getting goosebumps, and there's not one doubt in my mind, because there's been so much debt that's been accumulated at this zero, you know, money for free interest rates. And a lot of that debt is rolling over. But we also, you know, they keep calling for recession in 2020, which is ridiculous because it's already unfolding. But the reason why it's 2020 is because you've got trillions of dollars in derivative contracts that have to reset from being attached to LIBOR to being attached to whatever they come up with. And they're all working on coming up with stuff, but it doesn't have a fixed market that it can go into. And even if everything moves absolutely perfectly, it's the value of those contracts that will change no matter what, which changes the value, or the valuation rather, I should say, of all of the holders of those contracts. So all the financial institutions, the shadow banks, which are banks that do a lot of functions of banking, but they don't have deposits to bail in. So whether it's banks or it's shadow banks, so no, we are inside that transition, and it's a big one because central banks, even Janet Yellen, I love how these guys get out of office and then they admit things, you know, but even Janet Yellen says that we're going into this next crisis with very limited central banks tools, and that is absolutely true globally.
And I just want to say, I mean, we've been discussing, you know, a recession, collapse, and in our previous interviews that we've done, this is not something that's new. It just didn't come up yesterday. This was brewing since, you know, right after 2008.
Yes.
So we're in this illusion here. We've been in an illusion, and they've been propping the economy up since that time period. So yes, this is just the end part of it right now.
Exactly. You are spot on correct. And that's the thing. They kept it propped up to transfer the risk from the corporations, the few, to the public, the many. And they have a lot of tools, or they've had a lot of tools to do that with. In fact, interestingly enough, you know, I just told you how if you look at the real estate ETF, that's going up as the real estate market is declining.
Right.
But Toll Brothers in there is not behaving. Their stock is not behaving well at all. And I just did this little digging, and what I discovered, very interesting. And it really is the way that they transfer risk. And that is that the insiders, Robert Toll, who is the executive, the overall executive of Toll Brothers, has been selling his shares of stock like crazy. And so who's been buying it? Yeah, the stock keeps going down, but who's been buying it? Oh, guess what? It's institutional investors, which are Wall Street, that invests your money. And so here you know that it's in a negative market. These guys aren't stupid. They know this. And yet they're they're going in the institutions. So your 401k, your 403b, your IRA, any mutual funds, ETFs, variable annuities, all of these different plans, pension plans, are turning it around and buying this garbage, just like they're doing with the off the road, the secondary market treasuries. Nobody will buy there. There are no buyers there. So they put them in pension plans and IRAs and 401ks, and they transfer the risk. I mean, there's lots of ways to do it. That's one way. If you haven't seen that one yet, I'm actually doing it like shortly after we finish filming this, but you want to take a look at how they can invisibly transfer that risk. And see, the thing is, I've been saying this right along because it's just a fact. When enough risk has been transferred to the public, bailing out the system will become too expensive. And when you look at all of these bombs that are being lobbed at the global system right now, I'm really thinking that enough risk has been transferred and they are ready for the next crisis. I don't know if they're fully ready, but I think they're ushering it in.